Benjamin, thank you. Thanks. What an introduction. No pressure. As we saw 2 weeks ago, we Pommies aren't very good at pressure anymore, so I might choke this. Speaking of disasters, outside, has anyone been out the back in the last half an hour or so? Not only a disaster, but the definition, I believe, of irony. The Water Research Board's event has been washed out by a leaky roof. That's extraordinary, isn't it? You couldn't make it up. Speaking of things you couldn't make up, the clown, that is a true story. So over 20 years ago, I was working at my local petrol station as a kind of evening job. And this kind of smoky old car pulled up, and this person dressed as a clown sauntered into the kind of petrol station shoppy thing, beckoned for me to give him a bit of paper and a pen, and he started writing. He wrote the first sentence. Showed it to me. I am a clown. So yeah, no, I worked that out for myself, thank you. I am deaf. Okay, it's quite interesting. Carry on. I'm a bit short of money, and I'm about to go and do a kids' party, and I was wondering, between now and the kids' party, if you wouldn't mind lending me some tobacco. I said, well, obviously I can't just give you tobacco from the counter. It's my employer's stuff. I can't give you money from the till. I can't lend you money from the till. That's my employer's stuff too. So I thought about it for a bit, and I thought, I know what I'll do. I'll lend you the money myself. And I felt all sort of warm and fuzzy and happy for being a bit altruistic, and gave this chap a couple of quid. He bought his tobacco, and he said, he wrote, I'll be back later. And he went on his way. Presumably went and did his kids' party. I don't know if the tobacco was for the kids or not, or if it was for him, but it doesn't really matter. But he did the kids' party, didn't come back. A few weeks later, same guy popped into the shop. And I thought, okay, well, this is it now. He's going to give me my money back. Totally ignored it. Went about his business, bought some tobacco with his own money, or my money, or whatever, and left. There's no investment allegory in there. There's no kind of logic to it. It's an amazing story. I thought I'd like to share it with you. So I have been swindled by a deaf clown. And again, I haven't learned anything much from it, but I've never lent money to a clown since. So maybe that's the only thing you can learn from it. I'm here to talk about global investments. And as Benjamin already said, I've been doing this for 13 years as part of the group. I've flown down here and said, global investments are great. How about you give us some? Or give us some money, I suppose, rather than give us investments. And, increasingly over the last 5 years or so, we've seen the flows from our brothers and sisters at MFP go up a lot. Thank you for your support. Thanks for everybody looking after us in the room and, bringing money offshore and bringing it to us, which is fantastic. And so I suppose what I wanted to do today is give you a flavor for why you would do it, what's been going on, and what to expect in future. Because as Herman's rightly said, it is a bit of a confused picture out there. There's a lot of different macroeconomic winds and valuation issues and things to worry about. But I think ultimately, I'm not here to do a hatchet job in South Africa. I've never done that. In the 13 years I've been coming down here, I won't do it now. And, I'm actually a big fan of South Africa. I'm very pro-South Africa. I think it's a great country. And, as I say, I've worked for a South African firm for 13 years. So I'm not going to come and be kind of negative about South Africa. But what I do want to talk about is the benefits of investing globally. And these are benefits that are relevant for South African investors. They're just as relevant for people in Europe who want to invest globally. They're just as relevant for people in the US who want to invest globally. And I suppose ultimately it boils down to two things. The potential for returns enhancement, which we won't spend too much time talking about today, but there is definitely potential for returns enhancement. But the other one is diversification. Herman's talked about it already, the free lunch. And I hope by the end of this presentation, you'll go away thinking global markets are so big, so diverse, so exciting, that it's not a free lunch. It's more of a, 7-course tasting menu with accompanying wine. That's why I want you to go away and think this is the best free lunch ever. So we're going to spend some time digging into global markets, and we'll have a look and see if you're interested or not by the end. So, first of all, why didn't people invest offshore a lot in the old days? And obviously you had tighter and tighter exchange controls, which have loosened to be, I suppose, now almost to all intents and purposes non-existent. But despite that, over that period, people have still been a bit reluctant to take money offshore. And I think there's two reasons for that. The first one is this volatility of the rand and the reporting currency issues that you get as a result. Because the moment you take money offshore, if you continue to think about it in your base currency, it can be affected deeply by these 60, 70, 100% moves up and down by your base currency. So that's one of the reasons. Now, what we've seen recently, I don't know whether this will persist or not, but it's actually, a kind of fair amount of stability around that 14, 15, 16 level against the dollar. And so the reporting currency issues are less pronounced today, albeit with a weaker rand, than they were in the previous couple of decades. The other reason is because over the last 20 years or so, South African markets have generally done really well. Generated double-digit returns year over year over year, obviously with some volatility, of course. But what we've drawn here is the rolling 12 months performance of the local market, that's the red line, and then the blue line is the 12 months rolling return of the MSCI World, the global stock market. And what I've done behind them is shade the areas where global has beaten local. So the areas without shading, which is the majority of the graph, is where local has beaten global. Now recently, maybe this is why we've had more interest in global investments, because it's much more finely balanced than it was over a decade ago, where more often than not, your 12-month rolling return from South African markets was over and above what you'd get from global markets. And maybe that's just one of those things, or maybe it's because the nature of investing in South Africa from a global perspective, I'm speaking as a global investor, maybe the nature of investing here has changed a bit. So in the old days, outperformance, well, what generates outperformance? Normally, it's a risk premium. Why would you get a risk premium? Well, let's have a look. You see, this is the yield spread of your government 10-year versus the US 10-year. And if it's high, it tells you the market's perceiving this market as being risky. And if it reduces, the market's becoming more sanguine about the risks in this particular market. And as you can see, very markedly, that period of dropping of that yield spread, of perceived lowering of risk in South Africa in the sort of democratic era, coincided very nicely with those great returns from the equity market. Subsequent to that, we've seen a much flatter period, much more stability, I suppose, in terms of the perceived riskiness of South Africa. It's deemed as, it is what it is. That's great, because you know what you're getting globally. You know what you're getting in terms of your finance costs. That's fantastic. But maybe in an environment where you're not doing this, it's harder to generate outsized returns compared to global. Not saying it is, definitely, but it's something to bear in mind. And to move down another leg, that would require something special, I think. So what is the new paradigm? Again, Herman's much better placed to answer this than me, but this is your GDP growth, and you can see, again, the start of that democratic period, growth was really high, you're pumping. We all had the GFC, we've all suffered as a result, and globally, we've all kind of slumped in terms of our growth. South Africa's done it too. So as Herman rightly said, you're not immune from global forces. The issue you have here, and something to bear in mind, is that growth of 2% is very similar to the kind of growth we'd expect in the developed markets. And as Herman rightly said, this is a global market here now. You've got a lot of diverse revenue streams, which is good. But to get outsized returns versus the global markets, what's going to cause that? Is it going to be the local growth, global growth? Just worth thinking about. So I don't think there's necessarily the same investment penalty to going global that there used to be, because the local market was deemed riskier, you got more returns, the growth is higher, et cetera, et cetera. So that's just a sort of food for thought. So why invest globally? Let's start talking about diversification. This is not only a pretty picture, but it is. This is the world at night. Now, I'm sure all of you know the world doesn't have night at the same time all over the place. So what it actually is slices of satellite photos put together as a composite and created one picture of the world at night. Now, the only thing that's worth taking away from this is just look where the lights are. And think about that for a minute, because, yeah, sure, it's light pollution, that's bad, but what it also means is people, development, investment, spending, opportunity. And where is it? It's in the developed world. It's global. It's not all concentrated here. There's lots of it there. That's great. Well done, South Africa. Fantastic. But if it's not all there, so why would you have all of your portfolios here? Potential outperformance. I won't labor this. We talked about it earlier already. We have had a pretty rough ride at locally. Obviously, Yaku alluded to it too. And once you convert it into rand terms, being outside of South Africa has been very advantageous. But I don't want to labor that point because I think it's a bit of a once-in-a-lifetime thing. What you do get by moving outside of South Africa is much more diversification. This free lunch we were talking about earlier. You can see the number of firms in these different stock exchanges, and that's the entire JSE, which most people probably don't buy anyway. And then you see the size in terms of market cap, the value of the shares in these different markets. And you can see the global markets are massive, and they're very diversified because there's thousands and thousands of names that you can buy outside of South Africa. I suppose the converse of that is not only is South African market relatively small, it's very concentrated as well. So it's the antithesis of diversified. This is the proportion of the top 10 stocks in the JSE Top 40. So if you're buying the JSE Top 40, you're basically buying 10 stocks. They might all do really well, but they might not, in which case you're very subject to the returns of a handful of stocks. Huge amounts of idiosyncratic risk. If you think about going globally, the same top 10 stocks represent about 13%, about an eighth of the portfolio, and you get a massive long tail very, very quickly indeed. You can see, even by the time you get to, Alphabet, Johnson & Johnson, Nestle, huge global businesses, less than 1% of the index. So you're much less subject to business model risk from any one of these particular stocks. Diversification is a free lunch. You also get diversification in terms of sector exposure. So this is just taken from the MSCI again, and you have red bars here, which is the sector exposure in South Africa. The blue bars are the global exposure. And so just by naively buying a little bit of global markets, you create greater diversification, greater balance between your sector exposure. So you're less subject to a certain economic outcome. You can have more diverse economic outcomes still potentially benefit your portfolio. And that's just describing it in another way, showing where we've got greater weights globally and lower weights globally. And of course, you bash those two together, you end up somewhere in the middle, diversified, more diversified, which is, to my mind, a sensible thing to consider. South African economy, it's an amazing economy. I love it. I think you've got great rule of law, great institutions, things are set up well, it works. I think you're often more negative about it than I am. I think I'm quite positive about the economy here, but it is small. Don't lose sight of that. Just down here, this is the rest of the world. And likewise, if I was talking to an American, I'd say, look, you're only that. Why wouldn't you diversify outside of your market? Because there's a whole world out there to take advantage of. A whole world of brands, of businesses, world-class organizations that if you just stay locally, in any country, you won't get an exposure to. And I know some of those stocks are private. I know some of those are probably owned by South African firms, but the point is the majority of them are worldwide brands that you get access to by going overseas. Similarly, the fund managers we use. This is the list of the portfolio managers we use currently in our portfolios. They're all over the place, doing lots of different things. There's names you recognize, names you've got no idea who they are. And that's because we have a 15-strong investment team whose job is dedicated to finding the best managers worldwide in their particular niche. Who knew Birmingham, Alabama had a great fund manager? Austin, Texas. The only way you're going to know that is by doing great research. And it's quite nice, actually, finding managers away from the standard noise in the financial centers, London and New York. They have a very different perspective, they're a bit more isolated, and they can go about their business without kind of being influenced so much by what's going on in the financial services industry, perhaps. There's tens of thousands, dozens of thousands of managers out there, depending who you ask, 20, 30, 40,000 different funds that we can choose from. The world is unbelievably rich with investment talent. And so we spend a huge amount of our time identifying the best people in their niche and putting them together in portfolios for you and your clients. The portfolios are very diversified. You can see this is an example of it. The classic kind of balance model, I suppose, would have sat in that inner ring. You had some equities, you had some bonds, you had some company bonds, some credit as we call it, maybe some property to make things a little bit exciting. And the point that Herman made is absolutely right. In this fixed income bit, wherever it is, around here, government bonds, there's loads of government bonds with negative yields. They're awful. I think they're terrible value. We don't buy them. We don't have to. Look at all this stuff we can choose from when you look at subsectors, when you look at styles, when you look at different regional focuses. We've got so many tools in our toolbox that we don't have to force ourselves to buy government bonds in a market where they're negative yielding because they're very unattractive. We can go where they are attractive, or we can go to different subsectors that are attractive. We can find value even when the big holistic asset classes are looking expensive. And again, that's what my team spend their time doing. Had a few questions recently about this. And this is something we never talked about a few years ago, but obviously my countrymen have Brexited themselves, and so we get this question, isn't London failing? Isn't it doomed? And I'd politely say, actually, no. London is the world's financial centre, and its position post-Brexit is actually consolidating. Who knew? We do twice as much dollars in London than gets traded through New York. Twice as many. Just think about that for a minute. Twice as many dollars through London than New York. English law is the foundation of loads of legal systems worldwide, and even if it's not, you can go to pretty much any country, any financial centre, and you'll find a whole bank of common lawyers, sounds like an insult, but that's the name of the English legal system, common law. You'll find lots of common lawyers there ready to create contracts, service, do business, and so on and so forth. So London is buzzing, has deep pools of talent. People from all over the world come here. Even in our team, we have people from Vietnam, Italy, Australia, Russia, in our team in London. And that's a tiny little kind of subset of the diversity, the difference of thought, difference of influence that we get swarming through and kind of creating a great ecosystem that really is diverse and fantastic and I believe world-leading. A couple of examples, just very quickly. Foreign exchange, pre-Brexit vote, 2016, we had nearly 37% market share. We've now got 43% market share in London. So London's position has gone up post-Brexit. Another one, interest rate derivatives, 38%, 39%, now 50.2%. So, London is the center of the world for this financial market. And not only that, we're kind of center of the world from a time zone perspective as well. The two are related, obviously, because, we have Greenwich Mean Time, and for whatever reason, we managed to design it such that people spiral out either side of us time-wise, because we sort of came up with the notion of time zones a few hundred years ago. But what's great about South Africa, as you can see from the chart, we're only about an hour difference. So we're always available. We're always in roughly the same time zone. And so it means for us, as a global business, as Benjamin's already said, being sat in London is fantastic for us as part of the Momentum Group because we're essentially in the same time zone. We can always converse with one another. We can always be available during decent business hours. Whereas I suppose if you're dealing with, for example, the west coast of the States, you're talking about an 8-hour time difference. If you're dealing with Australia, a 10-hour time difference the other way, it's very easy to find doing business very difficult indeed. So let us do that for you. So what to expect? This is looking more in terms of long-term returns. Herman's obviously talked a lot about the short term, and I agree, there are risks out there. But this is what we should expect from the long run from different asset classes globally. Real returns in excess of inflation. We believe developed equities will return you about 6% every year over the long run in excess of inflation, 6% real, which is a great return. Emerging markets, because of their risk premium, their perceived riskiness, will give you a little bit more. And then you've got the other asset classes beneath. And let's not forget, dear old cash should beat inflation. Hasn't, negative interest rates or low interest rates, post-financial crisis, but through the cycle, over the very long term, we would expect cash to beat inflation, and you should get some modest return from cash. Hasn't happened for a while, but we expect it will happen again. The other thing to remind ourselves about investing globally, or anywhere, here as well, is your risk assets, the decent portfolio driving assets in the long run. They are volatile, but they do return great returns to investors over the long run. So this goes back to the 70s, 50 years data for the MSCI World on a log scale. So what happens if you just have a price scale is it gets very much dominated by the end result and the stuff at the start on the left-hand side, because it's magnitude, it's a lot harder to see. So I've gone for a log scale. So if it's a straight line, it actually means you've got a kind of an exponential growth rate. And you can see there, global equity market returns are phenomenal over the long run. Local market returns are too. I'm not saying it's one versus the other. Why not have both? Over 50 years, if you'd have bought the market in 1969, done nothing apart from reinvest your dividends, your money would be 63 times bigger. It's a phenomenal return. It's a long time, but it's a phenomenal return. I think more interestingly for us, as people who have to invest in markets is to think that on a quarterly basis, nearly 3/4 of the time, the market is higher at the end of a quarter than it was at the start of the quarter. Not the same level or higher, but higher. 143 times out of 200, if you're in the market quarter by quarter, you'll be better off by the end of it. Now, obviously, there's pretty significant drawdowns in there. It's not a one-way bet, but more often than not, data shows you that over the long run, you'll make good returns out of equities. And that's the case here, that's the case globally, and again, it's a great thing to have. Patience and time and the ability to sit through the difficult times is such a great gift, and that's the way that investors make money over the long run. Coming back to the experience for South African investors, I thought I'd bring up the rand again. You can see that in a year like this year, where the rand's been pretty flat, you haven't had a big impact on your global returns. The reporting currency movements are de minimis. But let's have a look at 2015. You can see a massive delta here between the dollar return and the rand return. Obviously, the rand's weakened, right, over that period. And let's see how impactful it is, because the fixed income return is practically the same. So there's a small difference between what equities and fixed income did globally in 2015. You bring that into South African rand, you get a huge difference. The point is, very simply and crucially, not just for South African investors, but for investors moving outside of their base currency, you've got to think of it in terms of what you've moved it into. It's a conscious decision to move out of that base currency. It's a long-term decision. Don't, month by month, week by week, keep thinking, what's it done in rand? What's it done in rand? What's it done in dollars? What's it done in euros? What's it done in terms of global purchasing power? Because that's what you're taking it offshore for in the first place. By all means, over the long run, make that assessment. It's quite an important one if you want to bring the money back. But month by month, week by week, even year by year, you're on a bit of a hiding to nothing emotionally, I think. Let's look at this diversification benefit. We talked about diversification being free lunch. I think it's a 7-course tasting menu globally with wine included. And that is a really big number in terms of the overall portfolio risk. So what this shows is a build-up, a contribution in a multi-asset portfolio from the volatility from each of these different asset classes. And because they're imperfectly correlated, they don't all move the same amount in the same direction at the same time, they counteract each other somewhat. And that counteraction, in this example, takes your portfolio risk down from about 9% down to 6%. So you're losing a third of your total portfolio risk just by being diversified. So it is akin to a free lunch. It's fantastic. And we believe very firmly in the benefits of diversification when creating portfolios to target outcomes, because it gets the journey to the outcome so much more comfortable. Let's talk about our outcomes and our journeys there too. Investment returns. These are our 3 FSCA-approved multi-asset portfolios. Been going since 2008. I was part of the team that launched them. I've been involved with them ever since. And the red line is our net of fees return. The grey line is our target. And you can see all 3 pretty handsomely ahead of their target over the long run. And also, very nicely, you can't see it on that chart, but the beauty is as you add more risk, that line becomes gradually or graduated steeper. So, the growth fund is more steep than the managed fund, so you get more returns. Managed fund is steeper than the cautious fund. You get more returns for taking on more risk, so you get rewarded. In terms of the peer group, this is quartile ranking. So first quartile means you're in the top 25% of managers. The asterisk there we put means that we are the best in the FSCA peer group on Morningstar since inception. So they're the top of the peer group in Morningstar since inception. Over 5 years, first and second quartile as well. So we thought we'd look against the entire Morningstar peer group, not just South African funds, against all Morningstar peers since inception. The funds are second and first quartile. Over the last 5 years, the funds are first and second quartile as well. So they've done a really good job. Putting it another way, because we worry about risk, of course, risk-adjusted returns against the FSCA-approved peer group, we are right up there, top left. We are forming the efficient frontier. So you get the best, or you have had, can't predict the future, but in the past you've had the best risk-adjusted returns from anyone in this market in these portfolios. And I won't name them who's in there, but when the cameras are off, we can play a game of rhymes with, and I'll happily tell you who they are, who they rhyme with anyway. With that, I'll thank you very much for your time. I think we've probably got a few minutes for questions. So if you do have any, please feel free to send them through to Slido. Thank you very much. What? Have we got one? Oh, yeah. Okay, they're basically the same question. Let me answer the first one first. As far as I'm aware, no bank has left the UK because of Brexit. They have moved some people to Frankfurt, and the number is actually very small. If you think about the millions of people literally who are employed in London, there are single, maybe tens of thousands of people that have had to move to Paris or Frankfurt, really as a defensive move on the part of these financial services providers. I think in time it will prove to be a big mistake. I think it's unnecessary, but if you're a big organization, it's worth you kind of hedging your bets a bit by moving people across. The reality is, if you've been to Frankfurt, even Paris, they don't have the same vibe as London. They don't have the same infrastructure. They don't have the same even provision of the arts and sort of social environments. You just don't have what London has. So the pull away from London is tiny. So to push people away is really hard. It's very expensive, and we've seen very few people do it. In terms of the financial services industry post-Brexit, we know today, we've gone through a very deep exercise making sure that what we have is passportable into Europe, that we have immediate kind of rights to operate within mainland Europe if we want to. So that's very straightforward. And I'm sure anybody who's worth their salt will be doing the same. So Brexit +1 will be fine. Over the long run, Europe will do what they've always done, which is try and compete with London, and they'll fail. Paris has spent the last 20 years trying to nick our market share. They failed every time. And I expect they'll do the same afterwards. And if anything, I think our position will be more competitive, and I think our market share might go up. That's the million-dollar question, isn't it? I can't give people financial advice. I'm not qualified to do it. But no, it really does depend on people's individual circumstances. It depends on whether they are thinking about leaving it out there forever, or whether they will have to bring it back at some point. Obviously, if we're talking to somebody, we've got a lot of clients who operate in the Middle East or Far East or Latin America, and they're expatriates, and they're going to stay out there forever. And so for them, their local currency might be Asian, or it might be US dollar, in which case, for them it might make a lot of sense to move a large amount of their assets into that currency to match their long-term liabilities. If people are staying domestically, you've got to have the right kind of balance between matching your liabilities locally, making sure you don't get caught short there, whilst having a little sort of diversifier or returns kicker offshore. So sorry, I can't answer that. Yaku would be better placed. Not necessarily. Is he not here? What's he got in the? What's the number in the focus funds at the moment? It's about 30, isn't it? Yes. Is it maxed out? There you go. That's an interesting guide for you, if nothing else. That's it. We're done. Thank you, everybody. Thank you.